You are not losing money because you don't know enough. You are losing money because everything you know is working against you. That's not a motivational statement. That's a clinical diagnosis. And if you stay with me for the next 30 minutes, I'm going to prove it to you so thoroughly that you will never look at a losing trade the same way again. Most traders believe the path to profitability is a straight line. You learn a pattern, you backtest a system, you master your entries, and then the money follows. That's the story. That's the pitch. And it is the most expensive lie in the financial world, not because it's entirely false, but because it contains just enough truth to keep you trapped inside it for years. Here is what nobody tells you when you first sit down at a trading terminal. The single greatest obstacle between you and statistical consistency is not your strategy. It is not your broker. It is not the market makers, or the algorithm, or the news. It is the operating system running inside your skull, the one that was built, layer by layer, over your entire life, specifically to do the opposite of what profitable trading requires. And before we go any further, I want to plant something in your mind. A question I'm going to answer at the very end of this video. The question is this: what does it actually feel like to execute without ego? Not what it looks like on paper, not the theory. What does it physically, neurologically, emotionally feel like to trade like a machine while still being human? Hold that, we'll get there. But first, I need to demolish something. 3 things, actually. There are 3 demolitions every serious trader must survive before they access anything resembling consistent profitability. Not 3 lessons, not 3 tips. 3 complete destructions of beliefs that you have spent your entire adult life building. And the brutal irony is that these beliefs, the ones that must die, are the exact beliefs that made you successful everywhere else. Your ability to work harder than the next person, gone. Your ability to think your way out of a problem, gone. Your ability to control outcomes through sheer force of will, gone. All of it has to go, and the market will take it from you, whether you volunteer it or not. The only question is whether it takes it violently, repeatedly, expensively, or whether you hand it over consciously, surgically, on your own terms. Let me tell you about a trader named David. David was not a gambler. David was an engineer by training, the kind of person who approached every problem in his life with systematic precision. He spent 8 months building a breakout strategy on the ES futures market before he ever put a single real dollar at risk. He backtested it across 3 years of data. He ran it through a Monte Carlo simulation. He stress-tested it in a paper account for 6 weeks. David did everything right. By the time he went live, his confidence wasn't arrogance, it was earned. He made money on his first trade. He made money on his second trade. By trade number 10, he was up roughly 4% on the month, and the system was performing exactly as the backtest projected. He felt something he hadn't expected to feel. He felt calm. By trade 20, something shifted. The calm was still there, but underneath it, something else was beginning to form. A kind of quiet certainty, a sense that he had figured something out that other traders hadn't. He wasn't talking about his account publicly, he was too disciplined for that, but internally, the story he was telling himself had started to change. By trade 30, David had begun to see his own results as validation, not of the system, but of himself, of his intelligence, of his process. The line between "my system works" and "I am someone who can read markets" had blurred so gradually he hadn't noticed it happening. And then he hit trade 40, a winner. 40 consecutive trades that, by the raw numbers, looked like evidence of either extraordinary skill or an extraordinary system. And here is where the story becomes important, because at trade 40, David did not feel triumphant. David felt terrified, not the sharp, sudden terror of a bad trade, something slower and deeper, because David was an engineer, and engineers understand variance. And somewhere in the back of his mind, a very quiet, very precise voice was whispering, "You do not know why this is working." He knew his system had a historical win rate of 58%. He knew that statistically, a 40-trade winning run was not impossible, improbable. but not impossible given the right market conditions. And that word, conditions, was the splinter under his skin. Because what if those conditions changed? He didn't know. He couldn't know. And for the first time since he went live, David sat down at his terminal the next morning and felt the full weight of that uncertainty pressing down on him. He took trade 40 own. He sized it the same. He followed his rules. And then he sat there, watching the tick data move against him for the first 3 minutes, and his hands started to sweat. He exited early. Not because his system told him to, because the anxiety became intolerable. The trade reversed and would have been a winner. He lost a small amount, but that wasn't the real damage. The real damage was that he had discovered something about himself that he could not undiscover. His emotional stability had been entirely dependent on a winning streak he didn't understand. Trades 42 through 50 were not a financial disaster. They were a psychological one. He started second-guessing entries. He started moving stop losses. He took 2 trades simultaneously when his system only allowed 1, trying to recover a feeling that the market had no intention of giving back. By trade 50, his account was down 11% from its peak, and his confidence that quiet, earned calm he'd felt at trade 10 was completely gone. Here's the clinical truth about what happened to David. His first 40 trades were not proof of skill. They were a statistically plausible cluster of wins inside a system that genuinely had an edge. But David's brain, which was built by evolution to find patterns and attribute outcomes to causes, filled in the gap. It told him a story. The story was, you are doing this. You are the reason for the results. And when the results changed, his identity changed with them. This is the hot hand. It's a concept from behavioral economics that describes the human belief that a person who has experienced success in a random sequence is more likely to continue succeeding. Basketball fans believe it about shooters, gamblers believe it about dice, and traders, even sophisticated data-driven traders, believe it about their systems. Because the human brain cannot tolerate randomness, it will manufacture meaning out of noise every single time. And this is not a character flaw. This is not a discipline problem. This is your brain performing exactly the function it was designed to perform. The problem is that function is catastrophically unsuited for a probabilistic environment where your last 10 trades tell you almost nothing statistically meaningful about your next 10 trades. David's real education didn't start at trade 1. It started at trade 41. It started the moment he had to look at a clean setup that matched every rule in his system and override the execution because the feeling wasn't right. That moment, that single decision, was the beginning of his most expensive tuition payment. I want you to imagine something for a moment. Pick up a glass of water. Not a full glass, just enough to represent the risk you've taken on in an open trade. Let's say it's 2% of your account. The glass feels light at first. You're holding it with one hand, no effort, no tension. You opened the trade, the setup was clean, you're within your rules. Now hold the glass for 5 minutes. The water hasn't changed. The 2% is still 2%. The risk on paper is identical to what it was when you first picked it up. But your arm is starting to notice the weight, not dramatically, just a low, creeping awareness that you are holding something and that you have been holding it, and that the longer you hold it, the more you become aware of what happens if you drop it. Now hold it for 20 minutes. The water is the same, but every part of your nervous system is now enrolled in the problem of the glass. You are not thinking about anything else. You are tracking it. You are managing it. You are running scenarios in your head about what happens if your grip slips. You are watching the market tick by tick, and each tick feels like a tremor in your arm. This is not a metaphor about patience. This is a neurological description of what open trade time does to the human body. The risk has not changed. The math has not changed. But the perception of that risk, the subjective, felt weight of holding an open position in the market, compounds with time. It compounds with every red candle. It compounds with every check of the P and L. And at some point, the weight becomes intolerable, and the trader does something, moves the stop, takes early profit, adds to a loser, anything not to manage the trade, but to manage the feeling of holding the glass. And I want you to understand something critical here. The actions that come from managing the feeling are not stupid actions. They are not irrational. They are your nervous system doing its job. The problem is that your nervous system's job, in this context, actively destroys your statistical edge. This is where the 3 stages of psychological reconstruction begin, and I am going to walk you through each one with the same level of precision that I'd apply to a surgical procedure, because that's what this is. This is surgery. Stage 1 is the death of certainty. Certainty feels like an asset. In most areas of your life it is. When you are certain about a relationship, a career decision, a value you hold, certainty provides stability and direction. Certainty is what separates decisive people from paralyzed people. In the real world, certainty is a feature. In the markets, certainty is a catastrophic bug. Here is why. When you enter a trade with high conviction, when you look at a chart and feel genuinely, powerfully certain that price is going up, you are not experiencing clarity. You are experiencing a neurological event that feels like clarity. The difference matters enormously. True clarity in the market would require knowing every other participant's position, their intent, their access to information you don't have, the macro catalysts currently in motion that haven't hit the news yet, the algorithmic triggers that will fire at specific price levels, and approximately 10,000 other variables that you have zero visibility into. What you actually have is a pattern on a chart and a rule set. That is not clarity. That is a probabilistic edge. And there is a fundamental difference between those two things. When a trade fails after a high conviction entry, most traders experience that failure as a personal indictment. The thought, often subconscious, is, I was certain and I was wrong, which means I cannot trust my own certainty, which means I cannot trust my own judgment, which means I don't know how to do this. And so begins the spiral. Think about a roulette table. A well-maintained European roulette wheel has a house edge of approximately 2.7%. That edge doesn't express itself on a single spin. On a single spin, anything can happen. The ball lands where the ball lands, but run 10,000 spins, and that 2.7% edge becomes an iron law. The casino does not care about any individual spin. The casino does not celebrate when red comes up 4 times in a row, and they do not panic when black comes up 12 times in a row. They know, with mathematical certainty, that the edge will express itself over a sufficient sample size. Your trading system, assuming it has been rigorously validated, functions the same way. Your edge does not live in this trade. It doesn't live in this week or even this month. It lives across thousands of executions, which means that any individual trade, any single outcome, is essentially noise. It is a single spin of the wheel. Treating it as signal is one of the most expensive mistakes a trader can make. But here's the problem. You are not the casino. You are not a dispassionate institution with an infinite bankroll and no ego tied to outcomes. You are a human being who made a decision, put money at risk, and is now watching that decision play out in real time. And your brain is going to attribute meaning to that outcome, whether you want it to or not. The death of certainty is not about becoming uncertain. It is not about approaching every trade with doubt or hesitation. It is about something much more specific and much more difficult, learning to execute with the same quality regardless of conviction level. It is the ability to look at a high probability setup and feel genuine enthusiasm, and then immediately recognize that enthusiasm as neurologically irrelevant to the outcome. You take the setup. You take it with discipline. You take it with exactly the same size and the same stops as a medium conviction setup. Because your conviction is not correlated with the market's behavior, only your edge is. This is the first thing that has to die, not the ability to read the market with confidence, but the belief that confidence is predictive. Stage 2 is the death of control. I want to address you directly here because I know who is watching this, and I know what you do. You move stop losses. Don't defend it. Don't rationalize it. You know you do it. You set a stop at a level that made complete technical sense at the time of entry. And then, when price approached it, something happened in your body. A tightening, a dread, and you reached in and moved the stop further out, just enough to give the trade a little more room. That's the phrase, isn't it? A little more room. What you gave it was not room. What you gave it was exposure. What you gave it was risk that was not in the plan, attached to a loss you were not prepared to take. You take premature profits. You watch a trade move in your direction beautifully, cleanly, exactly as the system projected, and then somewhere between entry and target, you feel a shift. A kind of possessiveness comes over you. This profit is real. It exists right now, in this moment, as an unrealized number in your account. And the thought arrives, what if it reverses? And so, you close early. You take 70% of what the system told you to take. You tell yourself you're being disciplined. You tell yourself that you banked profit, which is always good. But you have systematically, consistently, over hundreds of trades, compressed your winners while letting your losers run to the stop. And then you wonder why a strategy that should be profitable based on the backtest isn't profitable in live execution. The math is stark. If your system has a 55% win rate and a 2-to-1 reward to risk ratio, it is profitable. But if your live execution produces a 55% win rate and a 1-to-1 reward to risk ratio because you're consistently taking early profits and occasionally moving stops, you have taken a profitable system and made it a losing system, not through bad analysis, through the management decisions you make inside the trade. And I want to be precise about something, because I think the way this is usually framed does more harm than good. This is not a discipline problem. Calling this a discipline problem implies that you are simply not trying hard enough, that if you just grip the wheel a little tighter, you'd stop making these moves. That framing is wrong, and it's dangerous because it makes you hate yourself for something that is fundamentally not a character flaw. These actions, moving stops, taking early profits, micromanaging ticks, are acts of fear. They are the behavioral output of a nervous system that has correctly identified that your financial security is at risk and is trying everything in its power to protect you. Your nervous system does not understand trading edges. It understands threat. And an open losing trade looks, to your oldest and deepest neural circuitry, like an existential threat. The solution is not to fight that circuitry. You cannot win that fight. The solution is to remove the decision points. Truly profitable manual traders, the ones who approach the cold precision of algorithmic execution, do not rely on their in-trade willpower to override their nervous system. They remove the opportunity to make those decisions by treating execution as a mechanical process. Entry defined, stop defined, target defined, size defined. The plan is built before the trade is taken, when the emotional stakes are zero, and then the execution follows the plan with the same automation a bot would apply. This is what it means to trade like a machine while being human. Not to eliminate emotion that is impossible and not even desirable, but to build a system architecture that does not give emotion a vote on execution decisions. The question I planted at the beginning of this video, what does it actually feel like to execute without ego? This is where that answer begins to form. It doesn't feel like the absence of emotion. It feels like the presence of structure so strong that emotion becomes a passenger rather than a driver. Stage 3 is the death of avoidance. And this is the one that nobody wants to talk about. This is the one that lives in the basement. Every trader has a level of loss they know intellectually they can take. They set stops. They calculate risk percentages. They understand, on a cognitive level, that losses are a cost of doing business in the market. They have heard this 100 times. They believe it in the same abstract way people believe they will handle an emergency calmly until they are actually in one. And then the stop gets hit, and the loss is real. And what happens in that moment, the specific emotional content of absorbing a realized loss, is not what most traders expected. Because the loss doesn't just feel like money leaving. The loss feels like an indictment. It feels like a message. And the message is, you were wrong. You made a call. You committed. You were wrong. And now there is a record of it. In your account, in your trade journal if you keep one, in your own memory. The loss doesn't just cost you money, it costs you a version of yourself that was competent and correct. This is the fear underneath all the other fears, not the fear of losing money specifically, but the fear of being the kind of person who loses. The fear of feeling stupid in a domain that you have told yourself, told other people, told the universe that you understand. And because this fear is so intolerable, the avoidance mechanisms are sophisticated and creative and almost entirely unconscious. The most common form is what I call strategy cycling. The trader takes a loss, a real painful loss, and the immediate narrative construction begins. The strategy didn't work today because of X. The setup would have been valid except for Y. The system needs to be adjusted to account for Z. And within days, or sometimes hours, the trader is either abandoning the strategy for a new one or making modifications to the existing one not based on statistical evidence derived from a meaningful sample size, but based on the emotional unacceptability of the loss they just took. This is avoidance masquerading as analysis. This is the ego protecting itself from the experience of being wrong by finding external explanations for outcomes that were simply within the expected distribution of a valid system. The second form is preparation paralysis. The trader who needs just one more confirmation indicator, one more back test, one more week of paper trading. Not because the system isn't ready, but because staying in preparation means staying in a state where the failure hasn't happened yet, where the risk is theoretical, where they can still be someone who hasn't yet been tested. The third form, and this is the most subtle, is the subconscious self-sabotage of winners. Because if you win, you raise the stakes. If you win consistently, you raise them further. And at some point, the performance level you're achieving demands a self-image that your subconscious is not ready to inhabit. And so you find yourself making uncharacteristic errors on the verge of a good month. You find yourself sizing up at the wrong moment. You find yourself pulling the trigger late on a setup you know cold, not because you don't understand the trade, but because part of you, the deep, old part, that is terrified of the accountability that comes with success, needs to preserve the possibility that you haven't really committed to this yet. The death of avoidance requires something that cannot be faked. It requires learning to sit with the emotional content of a red trade without immediately moving to resolve it, not to enjoy it, not to pretend it doesn't sting, but to stay in the room with it, to look at the loss, feel whatever it generates, and then crucially to ask, what is this feeling a referendum on? Is this feeling about my strategy, about my execution, or is this feeling about my self-worth? And if it's the latter, to recognize that clearly and refuse to let it drive the next decision. Until a trader can look at a stopped-out trade as neutral data information about what the market did during a specific window of time, nothing more and nothing less, the subconscious will continue to attach identity to outcomes. And wherever identity attaches to outcomes, self-sabotage follows. Inevitably, reliably. Now we rebuild. I'm going to give you a 4-step protocol that you can implement starting today. Not conceptually, tactically, step by step. Step 1. Name the stage. Go back through your last 10 trades. Not to evaluate your strategy, not to look at the setups. Look specifically at your behavior inside the trades. Did you move a stop? Did you size down on a setup that was technically valid because you felt uncertain? Did you close a winner before target because you needed to bank the profit? Did you avoid a setup that matched your rules because it felt wrong? Find the pattern in the behavior, not the pattern in the charts. Then, name which of the 3 stages is most present in that behavior. Are you fighting the death of certainty, attaching your confidence level to your expected outcome? Are you fighting the death of control, micromanaging execution out of fear? Are you fighting the death of avoidance cycling strategies, or staying in preparation because committing to execution means committing to the vulnerability of being wrong? You will likely find evidence of all 3, but there will be one that is most dominant. Name it, write it down, put it somewhere visible. Step 2. Reframe the loss. Take the most painful trade from the last 30 days, the one that still bothers you, The one you have a strong narrative about, the one where the strategy failed, or the market was manipulated, or the news hit at the wrong moment. Strip every external explanation away from it, every single one, and ask, underneath all of that, what is the emotional wound this trade is covering? Was there a rule violation? Was there a moment where you felt the trade going against you and made a choice to avoid the pain of the stop getting hit? Was there a point where your decision-making became about managing a feeling rather than executing a plan? Find that moment. Name it precisely, not to punish yourself, to locate the exact point where the psychological intervention is needed. Step 3. The 5-second pause. Before every entry from this point forward, implement a mandatory 5-second pause between the moment you identify a setup and the moment you click the button. In those 5 seconds, ask one question. Am I trading an edge, or am I trading an emotion? Not as a rhetorical flourish, as a literal assessment. Is this trade in the system? Does it match the criteria? If yes, you execute. If you are uncertain whether it matches the criteria, you do not execute. And if you find that you're about to take a trade that doesn't match the criteria but you feel strongly drawn to it, you log that impulse. You write it down. You do not trade it. And you watch what happens. Because the data you collect from the trades you don't take is often more revealing than the data from the trades you do. Step 4. The identity-free challenge. For your next 20 trades, you are going to track one thing, and one thing only: execution quality. Not P&L, not win rate, not how the strategy is performing. You are going to define, before each trade, what perfect execution looks like for that specific setup. Entry at the correct level. Stop at the predefined location. Size within the rule. Target preset. And then you are going to score each trade on a simple binary. Did you execute the plan as defined, or did you deviate? That's the metric. That's the only metric for 20 trades. Not because P&L doesn't matter. It matters enormously in the long run. But because right now, in this specific phase of your development, tying your evaluation of yourself to P&L is the exact mechanism that keeps the psychological patterns in place. You cannot simultaneously rebuild your relationship with uncertainty, control, and loss, while also using your account balance as a daily report card on your worth. The two activities are fundamentally incompatible. So for 20 trades, you separate them. You take execution quality as the output. You let the market do whatever the market does, and you collect data. What you will find almost universally is that when execution quality improves, P&L follows, not immediately, not linearly, but across a sufficient sample. A clean execution of a valid system will produce statistical outcomes that match its edge. And more importantly, you will have built a relationship with your own behavior that is based on something within your control. That foundation is what everything else is built on. Now, I promised you something at the beginning of this video. I told you I would answer the question, what does it actually feel like to execute without ego? Here is the honest answer. It does not feel powerful. It does not feel like a cinematic moment of mastery. It does not feel like the triumphant version of trading you imagined when you first started. It is much quieter than that, and in some ways, it is more unsettling. It feels like taking a trade, and genuinely not performatively, not as a discipline exercise, but genuinely not knowing if it's going to win, and being completely at ease with that not knowing. It feels like watching price move against your position and experiencing the movement as information rather than as a threat, not numbness, not the suppression of feeling, but a fundamental reorientation in what the loss of money means, moment to moment. It means the market went here, not there. That's all. Nothing about you. Nothing about your ability. Nothing about your future. It feels like finishing a trading session where you had 3 losers in a row, closing the platform, and your self-image being completely intact, because the losers were within the system, because the execution was clean, because you did the one thing that was actually within your control, and you did it well, and you know that the edge will express itself over time. and you are entirely at peace with being a single spin in the wheel rather than the wheel itself. That's what it feels like, and it is not easily won, but it is won. Trader after trader, when they stop trying to force certainty from a probabilistic environment and start building a relationship with their own execution quality, something shifts, not overnight, but permanently. The market will be here tomorrow, the patterns will form, the edges will present themselves, and the only question is whether you show up to execute them as a professional or whether you show up to resolve something emotional that the market was never designed to resolve. You already know which stage is yours. I could see it in the way you watched this video. Comment below exactly which of the 3 deaths you are currently facing, not vaguely, specifically, stage 1, stage 2, stage 3, and what it looked like in your last losing trade, because naming it publicly is the first act of accountability, and accountability is where the reconstruction begins. Subscribe if you want to continue this conversation unfiltered. No gimmick indicators, no magic setups, no systems that promise certainty in an environment that fundamentally does not offer it. Just the raw psychology of what it actually takes to operate in these markets with consistency, clarity, and something close to peace. The edge exists. The question is whether you can get out of the way long enough to let it work.